Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So with Tesla stock closing at yet another all-time high, congratulations once again to all the Tesla stock hodlers. As predicted prior to Tesla's Q3 earnings, the Wall Street analysts, one after the other, continued to upgrade their Tesla stock price targets and publish new research, which I could probably sum up in just a few words. Practically everyone on Wall Street today is saying Tesla stock to the moon. If only we could have figured this out before the Wall Street stock analysts started telling us that Tesla stock would go to the moon. If only anybody out there realized that EV adoption would happen faster than people were forecasting. If only people realized that Tesla's margins were growing faster than most people expected. If only people realized that Tesla was maintaining a market share despite the supposed competition coming. If only people could have realized just how well Tesla was executing. If only somebody ahead of time could have known that Tesla's Q3 results would blow away Wall Street expectations and result in an absolute tsunami of new research and price target upgrades with comments like, "Oh shit, Tesla's executing better than we thought. Their margins are higher than we thought. There's more demand than we thought. Oh, and EV adoption's happening faster than we thought." If only we'd known, we might have thought to ourselves, I guess, given the fact that these analyst price target upgrades are going to be coming one after the other and lots of people think they know what they're talking about and will probably buy Tesla stock after their price target upgrades, after their new research, maybe before this happens, I should buy some Tesla stock. But of course, the only people who could have possibly known to do that are the people who've already seen somebody walking around in my latest merch design, buy Tesla stock. Now, there is no question, these are great conversation starters, very in your face. If you're interested in your own buy Tesla merch, link in the description. There's shirts, mugs, hoodies, long sleeves, phone cases, you name it. It's in the store, still sold out of butt plugs, but they'll be back pretty soon. So if you're interested, check out the link in the description. Guaranteed to start some very interesting conversations. Just a word of warning though, if you happen to know anyone who's ever been short Tesla stock, I don't recommend wearing this merch anywhere near them, drinking from the mugs anywhere near them, etc., because you're very likely to trigger their PTSD, and that would be unkind. And now, in related matters, to buying Tesla stock that is, in today's video, we'll be doing a deep dive into some recent research from Morgan Stanley, who now have a $1,600 price target on Tesla stock in their bull case, which, in my opinion, is extremely bearish. It's good to see Morgan Stanley making incremental progress and starting to see reality for what it is, Tesla's dominance, EV adoption, etc. If you love crypto, stocks, and free stuff, or just want to help out the channel, check out these great offers. BlockFi are launching the world's first Bitcoin rewards credit card. People in the US can earn 1.5% Bitcoin back on every purchase with no annual fee using the BlockFi Bitcoin Rewards credit card. Check out the link in the description. And for a limited time, you can get up to $250 in crypto bonuses when funding a new account on BlockFi, where you can use cryptocurrency to earn interest, borrow cash, and buy or sell crypto. If you want your free crypto, use the link in the description. And if you'd like up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $300 just for opening an account. And if you make an initial deposit of $5 or more, you'll get a second free stock valued up to $2,000. Seriously. Free stocks? Yes, please. And finally, if you're in Australia, the UK, or New Zealand, you can get a free stock with stake, also linked in the description. Thanks so much for your support, guys. Let's get back to it. Okay, let's get into the latest research from Morgan Stanley. Next step, a manufacturing revolution? Price target to $1,200. Reiterate, overweight. Now, just for the record, this is Morgan Stanley's base case, but when we actually look at the assumptions behind this base case, they're laughably low. So I think it's better to focus on the research behind their bull case, which we'll get into in a moment. In either case, let's read on and let's see what they've got to say about Tesla stock and what's changed since their $900 price target only a few months earlier. The next 12 months can demonstrate Tesla's manufacturing leadership, a step change in costs and complexity, and higher growth rate in vehicle user base. Our $1,200 price target implies roughly half the company's growth target, a constrained China, and virtually no autonomy. Now, I just want to expand on this to be very clear. Morgan Stanley's $1,200 price target assumes that Tesla is getting to about half of their long-term growth goal, assumes a very ordinary future for Tesla in China, and doesn't include any autonomy whatsoever. Let that sink in. Following Tesla's better than expected Q3 results, we are raising our price target to $1,200 from $900 previously and reiterate our overweight rating. Now, Oh my god, I mean, I hate to be that guy. I'm just kidding, I love to be that guy. But remember, before Q3, I said this is exactly what would happen. Better than expected Q3 results, then all the analysts upgrade their price targets. And this is literally what happens. There's probably maybe now like a dozen, 2 dozen price target upgrades since Tesla's Q3. It boggles the mind. Our revised volume forecast of 8.1 million by 2030. So taking a moment here, they're expecting Tesla will deliver just 8.1 million vehicles in 2030. Tesla aiming for 20 million. This is their base case. Not their bear case, their base case, which implies an annual growth rate of 28%, which is slightly more than half the 50% growth rate targeted by the company over the long term, which they reiterated on their Q3 call. We note that Tesla is currently growing sales year over year by approximately 70%. The key narrative. The Tesla you'll likely see over the next 12 to 18 months would demonstrate the capabilities of the trillion-dollar Tesla, emphasizing step changes in manufacturing, cost reduction, expansion in capacity, model lineup, and service offerings. Tesla's Q3 results were significant for two main reasons. 1. Extraordinary top-line growth despite industry-wide supply shortages. Tesla sales are now annualizing at 1 million units, 6 months ahead of our prior expectations. Again, I just want to take a moment here. First of all, great execution by Tesla throughout the quarter, no question. Second of all, it just shows how blind Morgan Stanley are. They didn't expect Tesla to reach annual production capacity of 1 million units until mid next year. They are reasoning by analogy. They're comparing Tesla to the growth of other companies. There's no way they could possibly grow that fast. This is a recurring theme, even in this research, and I'm calling it now because I'll be pointing out in 6 and 12 months that I called it ahead of time again. Morgan Stanley are massively, dramatically underestimating what Tesla's going to do over the next 6 to 12 months. Again, they just don't learn. 2. Industry-leading profitability. Tesla's 23% adjusted EBITDA margin puts it at the very top of high-volume automotive OEM margins, excluding Ferrari. For the record, I think the average selling price of a Ferrari approximately $300,000 or so. So this is understandable. Tesla's not quite at that level yet, but they're not far off it, which is kind of crazy. Tesla is making over $10,000 of EBITDA per car globally in one of the most difficult supply chain environments ever seen by the industry. Take a moment. Let that sink in. There's shortages, the price of their parts are actually going up, yet at the same time, Tesla printing money, more money on every car than anyone else out there. And this is under very difficult conditions, the toughest the industry has ever seen. The combination of better than expected growth and margins under difficult industrial circumstances gives us an opportunity to narrow the gap in our forecast to management's long-term targets. Following Q3 results, we now assume Tesla's unit volume compound annual growth rate from 2021 to 2030 is 28%. A reminder once again, Tesla's targeting over 50%. What's changed with our numbers and price target? Unit volume. By 2030, we increase our unit forecast from 5.8 million to 8. Man, I just can't deal with this. Okay, we've got to take a moment here. Let's think, let's do some math. Shanghai, long-term capacity, let's call it about 1 million units. It's getting there slowly. Fremont, long-term capacity, close to 1 million units as well. We're about 2 million. I'm being a little bit generous here, but play along at home for a moment. Then we've got Berlin, which is going to be 2+ million vehicles long term. That's 4 million units already. Then we've got Austin. Personally, I think that's another 3 million units. We're now at 7 million units just from those existing and under construction factories. Almost at their 2030 target with just what Tesla is already built or building. Does anyone see how obscene their estimates are? They're assuming that Tesla is basically not going to make any additional factories between now and 2030. Now again, I'm using ballpark numbers. The point I'm making is these guys are out of their fucking mind. Tesla's already talked about new factories being announced in a few years' time. We know that Tesla's innovating in terms of manufacturing. So out of the same size factory footprint, over time, Tesla will produce more and more vehicles. They're doing this faster, they need less space, they're reducing parts and processes. How daft do you need to be to not see this happening? Tesla has told us they expect to squeeze an additional 50% of capacity out of Fremont. It's already full. How does that happen? That's right, they're deleting parts and processes. They're becoming more efficient. Now apply that same increasing efficiency to all of the other factories over time as well. Morgan Stanley, if anyone's watching, the word of today, infer. I-N-F-E-R. You guys need to learn how to do that. This will not age well. I will be clipping this in a couple of years' time and laughing at their estimates. Honestly, this is just embarrassing. Auto gross margin. We expect total gross margins for the auto business to contract from 30% today to 27% by 2030. Now, I don't know what planet these guys are on. I don't know what they're assuming. Even if the average selling price of Tesla's vehicles is lower, that doesn't account because this is in percentage terms. Again, I ask the question, How high are the people at Morgan Stanley who are doing this so-called research? Tesla is becoming more efficient. They're doing more with less. They're becoming more profitable. They're deleting parts and processes. This doesn't end. They're benefiting more and more from economies of scale. Why on earth would their margins contract between now and 2030? I understand that the price of their vehicles are going to come down. Their margins are already increasing as the price of their vehicles come down. What is going to change between now and 2030 where this trend reverses? It's just mad. Honestly, this is embarrassing. This is from Morgan Stanley, not Gordon Johnson. Honestly, can someone please account for why in the actual they think that margins are going to contract over the next decade? It makes no sense. EVs are not a mature technology. But okay, let's move on. EBITDA and margin. Investors should consider that our revised price target is based on an exit auto EBITDA margin of 21%, which is lower than what the company achieved in Q3 2021. Me. I mean, honestly, guys, what the is wrong with these people? Seriously, let's just scroll up a little bit, okay? Tesla is making over 10k EBITDA per car globally in one of the most difficult supply chain environments ever seen by the industry. Okay, one more time. In the most difficult supply chain environments ever seen by the auto industry. But we think that their margins are going to be lower than what they achieved in the most difficult quarter in the history of the automotive industry. Let's just move on. But I hereby declare that henceforth in this video, Morgan Stanley will be referred to as Moron Stanley. Revenue. We forecast that total company revenue will grow from 51 billion in 2021 to 436 billion by 2030. So, spoiler alert, my Tesla valuation model, the one that's currently generating my price targets for Tesla stock, which are exclusively available on Patreon, card in the corner if you're not signed up, in 2031 has Tesla doing over $1 trillion in revenue, not including energy, not including robotaxi, not including HVAC, not including supply to any other companies, etc. Just out of interest, let me know in the comments below. Who do you guys and girls think is more likely to be accurate with their revenue estimates for Tesla in 2031? The guy with the mullet on YouTube who doesn't know anything about anything, or the 150 IQ mob over at Morgan Stanley? Just out of interest, let me know below. Morgan Stanley or this guy. So here's a little graphic Morgan Stanley have put together showing the gap, how it was bridged between their previous price target of $900 per share for Tesla stock to the new price target of $1,200 per share for Tesla stock, broken down by different aspects of the business. $194 in additional price target for Tesla stock from automotive, $2 from energy, $9 from insurance, $5 from mobility and rideshare, and $91 from network services. So the bulk of this coming from auto and a little bit from network services. Basically, because there's a larger install base of Teslas, there's more potential for monetizing their existing user base. The Tesla double flywheel. Growth in units equals growth in installed base. Around 80% of the value of our Tesla price target is driven by two key segments: the automotive business, around 50% of the total value of their price target, and network services, around 30% of the total value. The remaining 20% of our target is comprised of Tesla insurance, Tesla energy, Tesla mobility and rideshare, and EV battery supply to third-party customers. At our $1,200 price target, we see around 33% upside from the current share price. Our new bull case valuation moves to $1,600 per share, up from $1,272 per share, which represents 78% upside. A little bit less than that now, as Tesla stock has been on an absolute tear since this research was published just a few days ago. And stay tuned, because in just a moment we'll be looking at Morgan Stanley's bull case for Tesla and the assumptions behind that. Beyond volume times price. Tesla is the leader in EV manufacturing, batteries, and autonomy. Embedded within its company is a fast-growing, high-margin software business that has the potential for highly recurring revenues from its connected car software and services business. For example, full self-driving, charging, maintenance, upgrades, content, etc. And I want to expand on this a little bit. This includes infotainment, subscriptions to services, these kind of things. Remember, once Teslas are fully autonomous in particular, you no longer need to pay attention to the road. Just think about what's going to be happening inside a Tesla. Productivity, infotainment, entertainment, communication, etc. And do some real quick math here. Tesla sells 1 million cars this year, 1.5 million next year, blah, blah, blah. This very quickly adds up to an absolutely enormous install base of potential users, translating to people that might be spending money inside their Tesla on software. Alrighty. Let's first of all look at Morgan Stanley's bull case for Tesla stock, keeping in mind that this is still actually quite bearish. Okay, the bull case for Morgan Stanley, a $1,600 per share price target for Tesla stock for the bull case, assumes just 10 million units sold by 2030 with 22% EBITDA margins. Now, think about this for a moment. Tesla is aiming for 20 million units per year by 2030. Morgan Stanley assuming Tesla gets to just half of their goal And that's still a $1,600 price target for Tesla stock. And just for the record, Morgan Stanley's $1,600 per share bull case for Tesla stock, lower than mine. As I've said, if you'd like to see all of my up-to-date price targets for Tesla stock over the next 10 years, my bear case, my base case, and my bull case, there's a link in the description. You can join Patreon, check them out, plus a ton of exclusive content, videos, Q&As, and more. Now, I do just want you guys and girls to take a moment to let this sink in. Morgan Stanley's bull case assumes that Tesla gets to just half of their own stated goal. Let's read on just a little bit more. Morgan Stanley assuming about 50% penetration for Tesla insurance. Morgan Stanley assuming just 50% penetration on Tesla insurance by 2030. Now remember, Tesla has all the data. They have all the telemetry. It's going to be very difficult to beat anyone on price. Plus their vehicles are getting safer and safer over time. I expect this is quite bearish. But anyway, the final thing here. Morgan Stanley is assuming Tesla has a mobility ride-sharing network of just 1 million cars by 2030. Okay, we're talking about autonomous robotaxis. Just 1 million. Now, based on my own production estimates, Tesla's total fleet in 2030 is going to be about 100 million vehicles. Another way to think about this is if I'm right and Tesla's fleet's 100 million vehicles, this would mean just 1% of Teslas are actively participating in the robotaxi network. Just 1%. And now, the base case, $1,200 per share for Tesla stock. Again, it's assuming just 8.1 million units sold by 2030 and a piss poor operating margin. The bear case, not even worth talking about this. I mean, honestly, $500 per share. Keep in mind that these Muppets had a $10 bear case price target on Tesla stock maybe 2 years ago. So let's just throw that one in the bin. It's a joke. Where did we find an extra 2.3 million units, and how do we justify adding such volumes at this time? So, of the 2.3 million unit increase by 2030, roughly 70% is from rest of Asia and rest of world. Roughly 15% are from North America and Europe each. We remind investors that we forecast Tesla China volume to peak at 877 units by 2027 and decline materially thereafter. I mean, hey, you never know. Anything is possible. I understand the reasoning behind this as well. Morgan Stanley are basically thinking, well, the Chinese Communist Party is not going to be a big fan of Tesla having all these smart robots around there with sensors, so they're basically going to fuck Tesla in the ass. That may happen. I'm skeptical. The justification for revising up our volume forecast is driven by our continuously evolving views around the manufacturing capabilities of the company. Morgan Stanley, a little bit slow off the blocks. I hope somebody from Morgan Stanley are watching. If you are, just go watch everything Sandy Munro has ever had to say about Tesla. Book some time in with the guy, spend a couple of days with him, a few hours, whatever it takes. Talk to Sandy Munro. Ask every question you can possibly think of in terms of Tesla and manufacturing. Take notes, do your homework, and then I guess you'll be updating your price targets once again. Tesla is the most profitable mass market car company in the world right now, with EBITDA margins well over 20% and auto gross margins in excess of 30%. We believe that the market is underestimating Tesla's ability to bring to market breakthrough innovations in vehicle design and manufacturing. And let me just jump in here too. I believe that Morgan Stanley are underestimating Tesla's ability to bring to market breakthrough innovations in vehicle design and manufacturing. So hey, Morgan Stanley, like I said, go talk to Sandy Munro. We draw very clear similarities to the dawn of the mass market automobile era over 110 years ago. Prior to the Ford Model T introduction in 1908, the average price of an automobile in the United States was in excess of $80,000 in today's dollars. The Model T lowered this price to roughly $25,000 in today's dollars. But it wasn't until the moving assembly line in 1913 that customers saw a reduction in price of the Ford Model T to roughly $3,500 in today's prices. While the Tesla Model 3 and Model Y may have represented the Model T moment for EVs, we have yet to see the moving assembly line moment in the EV industry. We believe Tesla is uniquely positioned to push the boundaries at the epicenter of a manufacturing change in automaking. By the way, Morgan Stanley are right in this point. Tesla is going to change automotive manufacturing completely, but in my opinion, this is not accurately being represented in their price target. New plants. We assume Tesla is likely to add the following new plants: an India plant, a new China or Asia-based plant ramping in 2025, a new US plant, and an Eastern European plant. Okay, so remember we had that conversation earlier about the volumes and the existing factories, either existing or under construction, gets us to about 7 or 8 million units per year anyway. Morgan Stanley assuming a ton of new factories, yet only 8.1 million units by 2030. Math's not adding up here. By 2030, our total estimated Tesla plant count is 10, assuming Shanghai 1 and 2 is one plant. Now, there's no point really getting too bogged down in how many plants. What matters more is how much total capacity. If each Tesla plant, for example, is producing 2 million units per year, 10 plants, 20 million units. If each plant on average is producing 1 million units per year, they'll need 20 plants. So it's not so much the number of plants. How many vehicles is each plant producing on average? And we already know Berlin is 2+ million units. The Gigafactory in Texas is bigger than the Berlin site. It has far more land. Keeping in mind that Tesla wants to have everything on site at each of their factories, including raw materials going in and final products going out, it makes a lot more sense to be large scale and only have a handful, maybe 8 to 10 factories in total, producing around 2 million vehicles per year each, rather than having 20+ factories. Economies of scale. Makes sense. All right, so this is by far the funniest slide in the entire research report. I mean, I couldn't help myself but writing, okay, so let's run through this, all right? These are the Tesla capacity estimates from Morgan Stanley. Let's just jump straight to Berlin and Austin, okay? Okay, so I really do hope someone from Morgan Stanley is watching this. Guys, see the Berlin factory, right? You guys have got it doing less than 1 million units per year in 2030. Okay, let me explain how this works. Stage 1, the first quarter of the final build out, okay? 25% of the final build out is 500,000 plus units per year. When they do stage 2, that's another 500,000. We're already at 1 million with Berlin just 50% built out. Then yeah, that's right, stage 3 and stage 4 at another million. The Berlin factory, minimum output by 2030, if you're assuming there's no incremental improvements in manufacturing and output, should be at least 2 million vehicles per year. I just don't get it. Where are these assumptions coming from? It makes no sense. And the Austin factory, bigger site than Berlin. The only thing that's even close to reality is Fremont. I personally think it's going to ultimately get closer to 1 million than say 750,000. But in either case, they're probably not too far off with Fremont. Shanghai 1 and 2, ultimate capacity over 1 million, not too bad. But see, here's the thing that gets me. The average capacity for each of these factories appears to be about 1 million units, not even that. This is nonsensical to me. EV adoption is accelerating. It makes no sense for Tesla to make piddly little plants here and there. It's just so inefficient to have a smattering of plants that are producing 500,000 to 1 million vehicles per year. If you're going to be taking in raw materials at one end and producing final vehicles at the other, economies of scale matter. As we can see, Morgan Stanley were previously forecasting Tesla in 2030 to be producing just 5.8 million vehicles in a single year. I mean, holy shit, dude. They had Berlin at less than 600,000 and Austin at just over 600K. I mean, holy shit, guys. See, the funny thing is, this is going to happen again and again in maybe 6 and 12 months, and these are just going to keep going up and up and up. Someone please remind me in the comments when Morgan Stanley publishes their updated research to come back and troll them about these laughably low estimates. They're not going to age well. And possibly the most embarrassing statement in the entire research report from Morgan Stanley. It's really hard to keep it together, guys. I just know how poorly these are going to age, and these guys are supposed to be smart. Quote, we expect the global battery electric vehicle market to be at 40% penetration by 2030. 40% of new vehicle sales in 2030 will be electric, you say, Morgan Stanley. Could one of you please explain to me why anyone on planet Earth will be buying internal combustion engine vehicles and why they'll make up more than half of the new vehicle market in 2030? Given the fact that you've done your research and you believe that Tesla's manufacturing costs are coming down, the Model T moment just happened, but the moving production line moment hasn't happened yet on EVs. Could somebody please explain the logic here? Because I'm not following. EVs are almost at price parity with ICE vehicles today. A couple of years' time, they'll be cheaper, and they'll keep getting cheaper. Please explain to me what consumers on Earth who aren't completely insane will be buying ICE vehicles in 2030, such that there is still demand for more than half of all new vehicles to be ICE. So here's somebody else that the folks over at Morgan Stanley, I really do hope they're watching, need to talk to. Tony Seba. Organize some time to talk to Tony Seba as well. It'll be very helpful for your future research and to reduce the amount of roasting you receive on YouTube from guys that don't know anything about anything, who will be right in 2030 when you won't. We believe the current auto industry paradigm of volume per platform and volume per factory will be challenged and expanded over the next 24 months, thanks in part to Tesla. I completely agree with this. There are roughly 10,000 parts in today's internal combustion engine automobiles. Could it be possible to produce a vehicle with less than 100 parts? That's probably a step too far this decade, but the company is moving fast on significantly reducing part count and improving capability of key structural elements of the vehicle chassis. This has the potential to yield a step change in variable cost of auto production. Improved affordability unleashes higher volumes. Hey, Morgan Stanley, I just want you guys to read your own research here. Improved affordability unleashes higher volumes. But of course, Tesla's still only going to produce, even in your bull case, just 10 million electric vehicles in 2030, you muppets. In key markets such as India, non-China Asia, and other developing and developed regions, and this is actually a really good point. We believe Tesla will produce an average volume of over 800,000 units per plant by 2030. And in the case of Berlin, Austin, and one other US plant to be determined, we forecast volumes of around 1 million units per year or more. Spoiler alert, significantly more. Each 1 million units added to our forecast by 2030 is worth in excess of $150 to our price target. Let's do some quick math. Current bull case assumes 10 million units per year. Add another 10 million to get to Tesla's target of 20 million units per year. 150 times 10, 1500. That means a $3,100 or more price target for Tesla stock if today Morgan Stanley actually believed Tesla would produce 20 million units per year in 2030. Think about that. If Morgan Stanley were actually willing to accept that Tesla can and will hit 20 million units per year in 2030, their bull case today, actually their base case today, will be over $3,000 per share for Tesla stock. Today, about a tripling from where we are as I record this. Greater sales, more installed base, more services revenue. The compounding element to the growth of the Tesla fleet cannot be overstated. By the way, for those of you following along, PARC is just a wanky word for fleet. Our revised volume assumptions has lifted our Tesla global car fleet to just under 38 million units by 2030 and around 130 million units by 2040. As I said, I'm over 100 million units by 2030. Clearly, do the math, way in excess of 130 by 2040. But in either case, this is a smart way to be thinking about Tesla in the future. So, how is Tesla going to manufacture all these cars? Enter the Gigapress. The Gigapress is the largest casting machine in the world that is used to cast and produce car parts such as the rear body. A Gigapress is the size of a small house. Projected output and cost savings. Output: around 40 to 45 completed castings per hour and around 1,000 castings per day. Cost savings: in addition to removing the need for around 300 robots, please let that sink in. Tesla expects to save 55% in investment per gigawatt hour and 35% in floor space in order to make the vehicle factory of the future. But of course, they're going to fall dramatically short of their target of 20 million units per year in 2030. Tesla is building the car factory of the future. Tesla has the opportunity to completely reinvent the car manufacturing process for vehicle production, and factories, just jumping in here, they don't just have the opportunity, they currently are and will continue to do so. Given the trade-off between flexibility and scale, Tesla's view may be that it does not need a variety of shapes and car models to make a successful business. And I have to jump in here again, no shit, Sherlock. This is one of the things that absolutely blows my mind. The competition is coming. Ford and General Motors are going to have 69,000 different models by 2025. This is not a bullish signal. This is actually a very bearish signal. See, here's the deal. You only need make one category killer per category to literally, as the name implies, kill everything else in that category. You only need one mid-size sedan. You only need one SUV. You only need one compact SUV. You only need one pickup truck. The Tesla isn't going to have 420 different variations of every single vehicle you can possibly imagine. They don't need them. Consumers do not need as much variety as most people seem to think. The way that brands differentiate themselves, because let's be honest, pretty much every ICE car is basically the same as every other ICE car in each category, is the window dressing. Tesla has a completely different approach. Let's approach this from a different angle. How many different iPhone models does Apple ever sell actively at one point in time? Game, set, match. Why don't other auto companies use giant castings? We had the opportunity to speak to a senior body shop engineer of a major global OEM. Now, taking a moment here, this is actually really important, so pay very close attention to what is said and the outcome of this discussion. So, here's why the dinosaurs don't use a Gigapress. Number one, it's difficult to integrate into an existing body shop. The process eliminates the use of much of the advanced tooling, welding, riveting, bonding, and robotics currently in place at legacy automotive OEM body shops. This one paragraph here is an encapsulation of everything that's going to happen to legacy automotive as they transition to EVs. Most of the stuff they have today, most of the processes they have today, will no longer be useful or the most ideal and optimal way to produce EVs. This is going to be a very big problem for legacy auto. But here's the thing. As legacy automotive transition to producing EVs, they either need to scrap their existing tooling, robots, etc., or more ironically, try to shuffle and rejig and adapt and have a suboptimal outcome by trying to reuse as much of their legacy technology as they can to produce EVs. It's much better to go with a clean slate design, but that's brutally expensive. Flexibility for body shape. Traditional OEMs offer a wide variety of body shapes requiring lower production runs per nameplate and the need to change tooling, dies, etc. in a conventional stamping operation. Again, the implications here, Tesla only has a few killer products, and even the Model 3 and Model Y share most of their parts in common. So they're not reinventing the wheel dozens of times with dozens of different models and variations. Again, I want to remind you, how many different models of the iPhone exist, and are Apple doing okay with just that small selection of different models? Reusability, culture, other. Legacy OEMs are trying to convert existing ICE capacity to accommodate new EV production. In doing so, they are completely f***ed. Sorry guys, I went off track here. They look to reuse as much capital equipment and tooling as possible because they're idiots. Converting to a gigapress would essentially involve gutting the existing body shop and starting from scratch, which would be the intelligent thing to do if you want any chance whatsoever of staying in business and competing with Tesla. But that would be too hard and expensive, so let's not do that. So let's recap. First of all, Morgan Stanley here, extremely bearish on Tesla. Even in their bull case, they're expecting Tesla falls literally halfway short of their actual stated goal of EV production in 2030, only getting to 10 million units per year at the end of this decade. So again, take a moment for this to sink in. Morgan Stanley believe that if in 2030, Tesla just gets to 10 million units produced per year, the stock today is worth $1,600 per share. And for some unknown reason, Morgan Stanley also conjuring up a scenario in which Tesla's margins decline over time, despite the fact that they've posted record margins in the toughest time in the history of the automotive industry. I still don't get that one. Yet in the same breath, Morgan Stanley are willing to acknowledge that Tesla has a manufacturing lead like we've never seen before and is going to completely revolutionize how vehicles are produced. Now, I'm starting to sound a little bit like a broken record here because just a few months ago when I was going over and sharing my thoughts and comments on Morgan Stanley's $900 per share price target for Tesla stock, I explicitly said in that video and addressed these comments directly to anyone from Morgan Stanley who may have been watching, you need to grow some testicles and stop being gigantic fucking pussies. Stop reasoning by analogy, stop being timid little bitches, stop underestimating everything because no one's ever done it before and therefore we don't want to go out on a limb because you're going to be embarrassed in a few years' time. I guarantee within 6, maybe 12 months maximum, there's going to be another research report from Morgan Stanley with an updated Tesla stock price target, and you know what's going to have changed? Margin improvements. Volume improvements, EV adoption accelerating faster than we thought. The 10 million bull case for Tesla in 2030 for EV production is probably now going to be the base case. Maybe the bull case will be 12.5 million. And guess what's going to happen another 6 to 12 months later? The same shit again and again and again and again. So I'm trying to save you guys some embarrassment and time. Grow some kahunas, forget comparing Tesla to anything else you've ever seen before, start from first principles with a clean slate and try to figure out what are they actually going to accomplish this decade. Because until then, I'm going to keep roasting you guys. You get paid very well to be very wrong. I would prefer, if you're getting paid very well, to be closer to right. What's the point of having an incredibly bearish bull case? It doesn't make any sense, unless of course you guys are just trying to game the system and have an excuse to release new research every 6 or so months to your clients and get them to buy more Tesla stock and make more money selling Tesla stock. But of course you would never do that because that'd be a little bit unethical. Now, everyone has a different methodology around price targets. I'm not nitpicking in terms of how Morgan Stanley are getting to their price targets in their bear case, their base case, and their bull case. However, the assumptions that they're working on are just plain embarrassing. 10 million EVs in 2030 from Tesla. 40% of new vehicles sold in 2030 will be EVs and 60% will be ICE. I mean, you guys have got to be fucking kidding. So I hope everyone watching has enjoyed this video. I'm sure it won't be too long, maybe 6-12 months at most until there's another video analyzing Morgan Stanley's latest price target increase on Tesla stock, their latest increased assumptions around Tesla's margins, EV adoption, and Tesla's 2030 capacity. And I'll certainly be happy to roast these guys once again, unless they finally grow some nuts and get their numbers right. Let me know in the comments below, how many vehicles do you guys and girls think Tesla will produce in the year 2030? And speaking of 2030, I have a funny feeling literally every single person watching this video and everyone they know will probably wish in 2030 they'd taken the advice of my latest piece of merch. Don't forget, if you'd like your own Buy Tesla stock merch, there's a link in the description. Literally everything you can imagine: mugs, hoodies, shirts, long sleeves, phone cases. Like I said, butt plugs are sold out, but hopefully they'll be back in stock soon. I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. And don't forget the BlockFi Bitcoin Rewards credit card, where you can earn 1.5% Bitcoin back on every purchase. There's a link in the description. You can also earn up to $250 in crypto bonuses when funding a new account on BlockFi, also linked below. And finally, don't forget your free stocks with WeBull and Stake, also linked in the description. These great offers also help out the channel. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. below. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.